Now that we've got the big picture behind diluted EPS, let's work through some examples of convertible debt, convertible preferred stock, and stock options so we can understand fully how to calculate diluted EPS. So we'll start with convertible debt. We're using the same example that we're working on earlier with convertible debt dealing with Mesa Company. So Mesa started 2001 with 100,000 shares outstanding. They issued another 40,000 shares on April 1st and then repurchased 20,000 shares on July 1st. Mesa had a 2-for-1 split on May 1st, and they also have 40,000 shares of $5 preferred non-convertible stock paying a 5% dividend. Mesa's net income for 2001 was $800,000. So this information highlighted in these first three paragraphs here was the information that we used to calculate basic EPS. So if you recall, when we calculated this, the income was $800,000. So I'm just going to replug that over it. Preferred dividends was $10,000. And then our weighted average common stock outstanding was 250. All right, so this was our basic EPS. Again, we're just going to adjust that to get to diluted EPS. So I'm just going to go back one slide here. So then it tells us on January 1st, 2001, Mesa issued a $300,000 10% bond that is convertible into 15,000 shares of common stock post-split. Assume the bond was issued at par, and the tax rate in 2001 is 30%. In the case of convertible debt, since the bond is going to be convertible into 15,000 shares of common stock, we can add that 15,000 shares into the denominator. For the numerator, since we're dealing with a convertible bond, if this bond was converted, we would no longer have to pay the interest expense on it. So we're going to add back interest expense to the numerator. When we add back interest expense, it needs to be net of tax. That's because in the numerator, this convertible debt would affect net income. However, anything that affects net income is going to be reported net of tax, since it's below, net income falls below the tax line on the income statement. Hopefully you remember how to calculate interest expense. It's just principal times rate times time. So in this case, principal is $300,000, our rate is 10%, and the amount of time is 1 year since these bonds were issued on January 1st, 2001. So that gets us out to $30,000. If we look at interest expense net of tax, the tax rate here is 30%, so only the other 70% would affect net income. Right, so if we multiply 30,000 by 70%, we get out to 21,000. So that means our diluted EPS here is going to be 800,000 plus 10,000 minus 10,000 plus 21,000, and we'll add 15 to the denominator. Okay, so if we calculate all of that out, we would get out to 3.06. So diluted EPS is 3.06. And as you saw in a few slides ago, basic EPS was 3.16. So in this case, since the dilutive security causes basic EPS to drop lower than what it was, this security is considered dilutive, so we'll include it. If, however, we recalculated diluted EPS and it increases from 3.16, then it's anti-dilutive and we're not going to report this convertible debt in diluted EPS. Now, a quicker way to kind of determine whether any diluted security is dilutive or not, we can just look at the ratio of the adjustments we're making. In this case, we added $21,000 of interest expense back to the numerator. And in the denominator, we added $15,000 for the additional shares. If we divide 21,000 by 15,000, we get a ratio of 1.4. So in this case, since this ratio of 1.4 is less than basic EPS, that means by adding these to the numerator and denominator, we're going to end up diluting EPS. Let's go through one more example of diluted EPS with convertible debt. In this example, we have the same exact scenario as in the previous example, except now that the convertible bonds are issued on September 1st, 2001, instead of at the beginning of the year. So if we look at our work that we did previously in the previous example, we added 21,000 of interest expense to the numerator and 15,000 additional shares to the denominator. Again, however, we assumed that these bonds were converted at the beginning of the year, since the bonds were issued at the beginning of the year. In this case, since the bonds were issued as of September 31st, we need to think about how that's going to change the amount of interest we're paying and how that will change the amount of weighted average shares. So for our interest expense, we can recalculate this. We're still going to have principal of $300,000. We still have an interest rate of 10%. However, now instead of our time variable being 1, the bond's going to accrue interest from September 1st out until December 31st, or 4 out of 12 months. So in this case, if we multiplied everything through, we would get out to $10,000. Again, we need to add interest expense to the numerator net of tax, since everything that goes into net income is net of tax. So interest expense net of tax is going to be $10,000. Tax rate's 30%, so only 70% of the expense goes into net income, and we get out to $7,000. For our denominator now, for weighted average common shares outstanding, uh, 15,000 shares are converted. However, since those 15,000 shares are converted as of September 1st, the weighted average of those shares is only going to be for 4 out of 12 months. And so only 5,000 shares are going to be included into the denominator. Right, so in this case, diluted EPS, we're still going to start with basic EPS. However, in this case, we're now adding 7,000 of interest expense instead of 21,000. And our weighted average shares are only going to increase by 5,000. Okay, and so if we divide through, we find that diluted EPS is 3.13. That's still less than our basic EPS before, so it's dilutive, and we'll include these securities, these dilutive securities, in diluted EPS. This next example covers how we handle the calculation of diluted EPS when a convertible bond is actually converted during the middle of the year. The scenario is not covered in your CAISO textbook, but again, if you're taking the CPA exam, this is something you should be familiar with. So in this case, what's in red font is what's been changed from the previous example. So we still have a convertible bond here. Basic EPS, for the most part, is the same. We're going to see how it changes in just a bit. So the bonds are converted, or are issued on January 1st, 2001. And then September 1, the bonds actually converted. So if we go back to what we did previously, and we calculated basic EPS, I'm actually just going to get rid of all this. So earlier when we calculated basic EPS, we put in net income that hasn't changed. Net income was 800,000. Our preferred dividends were 10,000. And then we divided that by our weighted average common stock outstanding, which ended up being 250,000 shares. In this case, we need to change our calculation of basic EPS since on September 1st, the bondholders actually convert their bonds into common stock. So in this case, our weighted average common shares outstanding is going to increase. And it's going to increase by these 15,000 shares from the weighted average from September 1st to December 31st. So we're just going to add the 15,000 shares, and we're going to multiply by their weight of 4 out of 12 months. So if we recalculate basic EPS, we have 790 in the numerator, and we have 255,000 shares in the denominator. If we calculate this out, you will get to, typo here, of 3.09804. Now to calculate dilutive EPS, we're going to adjust our basic EPS number. We're going to include interest expense in the denominator, or in the numerator, and we'll add the weighted average common shares outstanding from the additional shares in the denominator. However, in this case, since the bonds were actually converted on September 1st, and we're going to assume that these bonds were converted as of January 1st, we only need to add in the interest expense from January 1st out to September 1st. So off to the side here, I'm just going to put from January 1st to September 1st for both cases. Okay, so if we calculated interest expense from January out to September, it would have been for 8 months. So we'll take the principal of 300,000, multiply by the interest rate of 10%, and then we're multiplying by 8 over 12. And that'll get us out to 20,000. And then same thing for the shares. We'll take the 15,000 shares and we're multiplying it by 8 over 12, and that'll get us 10,000. Don't forget the interest expense we need to add in net of tax. So let me just calculate that real quick. It'll be the 20,000 times 70%, or 14,000. So for dilutive EPS, we'll add 14,000 to the numerator. So it'll be the 790 plus the 14,000, and for the denominator, we'll add the 10,000 shares to that. Right, and then from there, we can just calculate through, and we would find that the diluted EPS is 3.304. The next topic we'll cover is how to calculate diluted EPS when a firm has convertible stock. Before we actually cover the example, let's just think about how convertible preferred stock would affect the EPS number if we assumed it were converted. So basic EPS, again, is just net income minus preferred dividends. we're dividing by weighted average common stock outstanding. To calculate diluted EPS, we're going to again assume that these preferred stock are converted either from the issue date or the beginning of the year if they were already outstanding. So again, we'll take basic EPS, we'll make adjustments to the numerator and the denominator. So if we have any preferred stock and it's converted into common stock, obviously then we're not going to be paying any preferred dividends on the preferred stock that's converted. So to the numerator, we'll add back in our preferred stock dividends. And then to the denominator, when the preferred stock gets converted into common stock, we're going to add in the converted shares. So for example, we're still working with Mesa Incorporated. They started 2001 with 100,000 shares outstanding. Again, they issued 40,000 shares on April 1st. They purchased 20,000 shares on July 1st. They have that 2-for-1 split on May 1st. And then they have 40,000 shares, a $5 par preferred convertible stock paying $5 a 5% dividend. Net income's $800,000. So if you remember before, our basic EPS when we started calculating this was $800,000 net income, $10,000 in preferred dividends, and when we calculated out the weighted average common stock outstanding, it was $250. Right, so this was our basic EPS before. In this case, it now tells us the 40,000 shares of $5 par preferred common stock are convertible into 20,000 post-split shares of common stock. Since the stock was already outstanding as of the beginning of the year, we're just going to assume these are converted at the beginning of the year. So we're going to add to the numerator all of the preferred dividends, since this covers all of the 40,000 shares. So we'll just add back the 10,000. And then to the denominator, we don't have to weight the number of shares since they're assumed converted from the beginning of the year. So we're just going to add back the 20,000. Right, so from there, we can just add it in. We can recalculate our diluted EPS, and we would find that dilutive EPS is 2.96, which is less than our basic EPS of 3.16 before. Now, let's just assume what if the 40,000 shares of $5 preferred stock are convertible into only 3,000 shares of common stock. So in this case, we would be adding, again, 10,000 to the numerator, but we're only adding 3,000 to the denominator. If we look at 10,000 divided by 3,000, get to 3.33. Right. This ratio is higher than our basic EPS, which means in this case, when we add or when we adjust basic EPS to dilutive EPS, it's going to end up increasing the EPS number. So it's going to be anti-dilutive. So in this case, we would just not report diluted EPS from these convertible stocks. The final topic we need to cover is how to calculate diluted EPS when a company has options and or warrants. So again, to calculate diluted EPS, you start with basic EPS, and then we're just going to make adjustments to it. Again, we need to ask ourselves, how would net income or preferred dividends change over the year if these options or warrants were exercised as of the beginning of the year? If we go back and look at the accounting we learned for options and warrants so far, if these options and warrants were exercised at the beginning of the year, it wouldn't affect net income or dividends. So for options and warrants, there's no adjustment to the numerator. However, for the denominator to figure out the effect, we're going to use the treasury stock method. To understand the treasury stock method, let's first just go over the basics of a stock option. So again, a stock option, this gives the holder the right to purchase stock at some point in the future at some price, which is known as the exercise price. Right, so when a holder exercises the option, they give the firm the exercise price, and that firm's going to get that cash for it. So under the treasury stock method, we're just going to assume that when the company gets the money for the exercise price, they're going to take that money, they're going to buy stock from the market using that money, and they're going to issue that stock that they repurchased out to whoever exercised the stock option. So if that's the case, if the exercise price is greater than the market price of the stock, then the company is going to get enough money to buy all the stock it needs to give to its option holders. So if the company is just going to buy the stock from the market and then give it back out to the option holders, they don't have to issue any more shares. And if they don't have to issue any more shares, they're just repurchasing the stock, then it's going to be anti-dilutive since nothing's going to happen to the denominator of EPS. Another way to kind of think about this is if the exercise price is higher than the market price, the option holder would pretty much have to be an idiot to exercise the stock option because they're going to pay more for the stock than they could just pay for if they bought it from the market. Right? So in that case, no one's going to exercise the option, so it's going to be anti-dilutive. If, however, the exercise price is less than the market price, right? In this case, the company is not going to get enough money from the exercise proceeds to buy the shares it needs to give to its option holders. In that case, then, the company is going to have to issue more shares in order to give shares to its option holders. So in that case, if more shares need to be issued, we're going to add more shares to the denominator of diluted EPS, so it will be dilutive. Let's go through an example here. So going back to Mesa, we have the same exact information for basic EPS. And in this case, now we have 5,000 stock options outstanding. Each option entitles the holder to buy one share of common stock at an exercise price of $20. The average market value of common stock is $25 per share. Tax rate is 30%. So again, basic EPS is the same as before. So to calculate this, we'll plug in 800,000 for net income. Preferred dividends is 10,000. And our weighted average common stock outstanding, if you recall, we calculated it out to be 250. All right, as I mentioned, stock options aren't going to have any effect on the numerator for diluted EPS, so no adjustment up in the numerator. For the denominator, we're going to use the treasury stock method. So if there's 5,000 stock options outstanding and each option entitles the holder to buy one share of common stock, then in that case, we have 5,000 shares that could potentially be purchased. If each has an exercise price of $20, that means if we assume these shares were going to be converted, we would have a total of $100,000 that we would receive when these shareholders exercise this. Again, under the treasury stock method, we're going to assume the company is going to take this $100,000 and they're going to purchase common stock with it. All right. It tells us the average market value of common stock is 25. So our exercise proceeds are 100,000. If we use this to buy the common stock, we can divide that $100,000 by the $25 market value. Right, and we would find that we could purchase 4,000 shares off the market to give to our stockholders. However, now, in order to, since we're assuming that we have to give 5,000 shares to the option holders, and we can only purchase 4,000 shares, the difference between the shares that need to be issued and the 4,000 shares we can purchase is going to be the 1,000 of additional shares we need to issue in order to satisfy our option holders. So in this case, we will add $1,000 shares to the denominator of diluted EPS, and then we have calculated diluted EPS for this case. So then in this case, we would get out to a diluted EPS of 3.15. That's less than basic EPS of $3.16. So we would include these options and warrants in the diluted EPS calculation. This next slide just covers how you would handle the accounting for, or the calculation of diluted EPS for options and warrants in some scenarios that aren't covered in your textbook. I'm not going to ask you about these. I just wanted you to be aware of these situations. In case you're studying for the CPA exam and you look back at your notes, you can kind of refer to this. I'm also going to skip past the slide. I won't ask you about contingently issuable stock. I'm not going to ask about presenting EPS on the income statement. I'd just like for you to be able to calculate diluted EPS. And then this last slide just summarizes how we calculate diluted EPS for convertible debt, convertible stock, and stock options. And that sums up Chapter 16.